Hello, I'm Pat O'Hare, Chief Market Analyst for Briefing.com. Today is Tuesday, March 17th, St. Patrick's Day. Happy St. Patrick's Day, everyone. A few Fridays ago, when the February employment report was released, the market traded in a wide range. In forlorn fashion, participants watched the S&P 500 trade down 2.3% to 666.79 in the wake of the report. At the 666 level, we then saw divine intervention as the market rallied 2.5% in the closing stages of trading to eke out a small gain that day. We draw that past Friday's trading to your attention because we couldn't help but think that yesterday's trade had a similar feel to it, only in reverse. The market got out of the gate early and extended its advance in gleeful fashion, gaining 2.4% at its peak of 774.53. Then the music stopped and the S&P dropped 2.7% in the final 2 hours of trading. At yesterday's peak, in fact, the market had gained 16.2% over the span of 7 trading sessions, so it was getting into an area where technical traders would consider it overbought on a short-term basis. All that really means is that a lot of people felt the market was ripe for some profit-taking. That's understandable, but the sudden reversal of fortune brings market participants back to that perilous position of wondering what's next. We can't know for certain, but we suspect it could be a bit of a roller coaster ride with the FOMC decision Wednesday, a business update for GE Capital on Thursday, and the quarterly options expiration on Friday. There is also a possibility that the Treasury Department releases details of its Public-Private Investment Fund initiative, which is aimed at helping banks get toxic assets off their balance sheets. The long and short of it then, no pun intended, is that it is probably best for most investors to sit tight and to pick and choose the spots where they want to get involved with longer-term positions. It has been said that this is a stock picker's market, but the short term is apt to be volatile, which will make it extra difficult to pick the right stocks at the right time to try and capture outsized short-term gains. Separately, the February housing starts report produced better than expected news, with starts increasing 22.2% from January to an annualized rate of 583,000 units. That compared to the consensus estimate of 450,000, but is still 47.3% below the year-ago level. Permits, meanwhile, increased 3% to an annualized rate of 547,000, which is still 44.2% below the year-ago level. The primary swing factor for starts was the increase in multi-unit structures. Specifically, starts on dwellings with 5 units or more surged to 212,000 from 118,000 in the prior month. Single-family starts, on the other hand, rose just 1.1% to an annualized rate of 357,000 units. By region, total starts were up 88.6% in the Northeast, with single-family starts up 54.2%. Up 58.5% in the Midwest, where single-family starts were up 12.8%. Up 30.2% in the South, with single-family starts up 2.5%. And down 24.6% in the West, where single-family starts declined 24.1%. The February report is better than feared economic news and could factor favorably in revised forecasts for Q1 GDP. However, it isn't the type of good news that is going to jumpstart the market, which is concerned that a pickup in starts and permits in the face of a glut of inventory of unsold existing homes and the shadow inventory of foreclosures that haven't hit the market will get in the way of clearing the excess supply of existing homes that is needed to help stabilize prices. In other economic news, the core rate in PPI rose 0.2% for February. This follows gains of 0.2% in December and 0.4% in January. The core rate continues to defy the weak demand, which is undoubtedly pressuring producers as capital equipment prices were up 0.1%. It is likely that the trend in core prices will weaken in the months ahead. The total PPI was up 0.1%. A surprising 1.6% drop in food prices held back the overall gain. Energy prices were up 1.3%, about as expected. Food and energy each account for about 18% of the total index. The overall PPI data reflect few price pressures as the year-over-year increase for PPI is at minus 1.3%. The core rate is at 4% on a year-over-year basis, but falling. These data don't present any major surprises and won't alter inflation expectations, especially with the more important CPI data out Wednesday morning. I'm Pat O'Hare for Briefing.com. Thanks for listening.